Good morning, Jeffrey Christian, CPM Group. It's about 11:45 on Tuesday, the 9th of November here in New York. I wanted to talk to you today a little bit about silver and gold, the current investment position, and our price outlook. Prices have moved up. They've broken out of their trading range to some extent, but to some extent they're not. Go through that. And then I wanted to go into a few other macroeconomic factors that are in the background. Producer price inflation, the indices came out today. I'll show you some data on that. I wanted to talk about the supply chain realities and some of the factors, a couple of the factors behind the disruptions, and also the essence of the chip shortage, because I have picked up that there is a great deal of, well, maybe not a great deal, but there is some confusion as to the nature of these disruptions, both in the supplies of chips and the supplies of other things. First thing I wanted to do is show you U.S. Mint gold and silver coin sales. These are annual figures. The blue annual data, for 2021, the blue line is the year-to-date figure, and the orange line is the same period of time through October last year. So you can see there has been a very sharp increase year over year. We're already the highest level since 2010 for gold coin purchases in the U.S. Mint, and there's a big increase over last year. And with silver, you can see that it's not quite as high as the full year of 2020. It's higher than it was through October of 2020. It's the highest level since 2016, and it's strong. That's important for a couple of reasons. First off, these are longer-term physical investors, and they continue to buy gold and silver from the U.S. Mint, other mints that don't publish monthly data, and in bar form. The second thing is there are people out there who continue to say that the mint isn't even producing silver coins because they can't get enough silver because there's a shortage and a fundamental lack of physical silver out there in the world. That's not true. The mint did have some problems in the past, in the not too distant past, I guess earlier this year, on not getting high quality coin blanks. We've explained that in previous videos, but the carnival barkers and the snake oil salesmen, they continue to persist in that, and they continue to persist in saying that the mint isn't producing silver coins, that you can't get silver coins. You can. You have to go to a legitimate dealer and not a snake oil salesman, but you can get them. And the mint actually is producing more than it has in any given year since 2016. So no shortage of silver, and there's no shortage of silver coins. My next couple charts show you bullion, and this is for gold. London bullion vaults, yes, they've come off a little bit in October, but they're still at record highs. There's more gold in bullion form in London, and that actually includes coins too, the London holdings, than ever before. And this is the COMEX gold stocks through today, or through yesterday. And you can see, the brown is the registered gold inventories, record highs, not only record highs, but record highs by a multiple of what they were in the past. Gold inventories on a registered basis are roughly 3 times, well, they're almost immeasurably larger than they were when they were very low, about 1 million ounces. They're 15 times higher. And when you plug in the eligible material, which can be re-registered with a click of a computer stroke by delivering the depository receipt notices to the clearinghouse, you have record highs that are 7 times larger than they were in the past. So there's plenty of gold out there. And the same is true with silver. Again, London, you've seen a little bit of a reduction in the inventories in London over the last couple months, over the last few months, but they're basically at record levels, and they are, very sharp compared to where they were, say, 5 years ago when the London bullion industry began reporting these figures. Similarly with silver, you'll hear the snake oil salesman talk about how COMEX is running out of silver. It has seen a drawdown of registered inventories. Most of what came down out of registered inventories went into eligible but unregistered stocks. So COMEX total inventories and COMEX registered depositories remains a little bit off from where it was at the beginning of the year, but at very high record levels, and levels that are 5 times larger than what they used to be over a long period of time. So plenty of silver in New York, plenty of silver in London, and plenty of silver in Shanghai. There's plenty of silver to meet the strong investment demand that we're seeing. So what's that mean for the price? You can see gold and silver prices really since the beginning of 2019. And you can see that channel that we've been in really since about the middle of 2021 for gold and to some extent for silver. We've seen a very strong upward move in gold and silver prices over the last couple of days. Higher inflation figures, stronger economy, interest rates came off about 8 basis points for the 10-year bond. But we're still in that channel. We're testing the upper limits of that channel. And, on a short-term basis, CPM Group today has issued new trade recommendations for gold and for silver. And we're saying, gold is now broken above 1800. It's actually broken above 1820 today. It's gotten up to about 1832. There's some technical resistance around 1835. And there's a very strong push to move it toward 1850 in the near term. One of the things that's happening is that both gold and silver have active December trading months. So you'll see the December roll supporting upward pressure on prices over the course of the remainder of November. Silver, similarly, we've broken above $24. The next stop is $25. We haven't gotten there yet. There's a lot of resistance just above where we are today. We saw that this morning. The price was bouncing off of a technical resistance level. It came back off about 33 cents. When it wasn't able to break above that, technicians sold. When it came back down 33 cents, they bought. And as I'm talking to you, it's off about 20 cents or 15 cents from yesterday's close. So we're still in those trading ranges. But as I've said in recent videos over the last few weeks, we do see the prices rising modestly higher yet this year. And this may be the beginning of it. We might see it into late November with the December roll. And then depending on where we are, see it continue beyond the December roll and really in across December. Now, background economic factors. And I apologize for the poor quality of these charts, but these are US government issued charts, GI charts, and they don't necessarily lend themselves to easy revision and modification to make them larger. But the US Producer Price Index came out today, and you look at it and it's pretty much the same. Now, I've made the point in the past and I'll make it again. The PPI tends to be more volatile than the CPI. It's the nature of the economics of wholesale business among businesses and consumer business, which is spread out over a wider range of issues and a wider range of participants. So the PPI historically is more volatile than the CPI, but it's sometimes a leading indicator of the inflationary pressures you might see at the consumer level. We see on a headline basis about 8+% increase year over year in the PPI in October compared to October of 2020. On a core basis, excluding food and energy, which are more volatile than other sectors, it's about 6.2%. That's still very high, and you can see it's very high. But you also can see that a year ago, we had deflation. We had people not buying stuff, companies not buying things, and you actually had a decline in prices below zero. Prices were declining because of low demand. So measuring things year over year from a very bad period in October of 2020 to a recovery phase and expansion phase in the US economy in October of 2021 is a little bit misleading. So just as with the CPI, with the PPI on the right-hand side, we're looking at month-to-month changes. You can see the red line, which is again the headline inflation, is still very high. But if you look at the month-to-month changes in core inflation on a PPI basis, we're back into that level that you've really seen for most of the past couple decades. So we are seeing some transitory nature in PPI, producer price inflation. Now, one of the factors that's been causing producer price inflation are the supply chain disruptions. And you hear all kinds of spooky things about it, but I'll just give you 2 points. So these charts are on the left-hand side. This is US imports of goods in billions of dollars. And you can see it's up very sharply from a year ago when no one was buying anything. But it's also up sharply from 2019 levels, and it's at record levels. The reality is that the United States is importing something like 25, 27% more goods today than they were prior to the pandemic and lockdown. The right-hand chart is the percentage change year to year from a year ago in imports. And one of the issues that you have had problems with the lockdown and the pandemic and a slow restart for international trade. You've had a lot of problems with tariffs that the US has imposed on goods from all around the world. You've had problems with political interruptions. You've had problems with production of goods to be imported into the United States. There are all kinds of issues that are there. There's also some really nasty issues related to longshoremen work habits in the ports of Los Angeles and Long Beach. And LBC and Los Angeles are probably the 2 largest ports of entry for goods being imported into the United States. And so you have a number of logistics that have caused delays in shipping and unloading ships in there, and it makes good videos for the evening news. But one of the factors is we're importing more goods than ever before by a wide margin. And we didn't go from this long upward trend to where we are today. We went to this long upward trend, then we slammed on the brakes, and you saw this very sharp decline in imports. And then we said, okay, now that we've slammed on the brakes, let's reaccelerate, but let's not reaccelerate back to where we were in 2019. Let's go much further. So you have a system that's somewhat constrained. Now, people keep showing those ships at berth outside of Long Beach, and that makes good graphics on the evening news. A big part of the problem actually has to do with once you get the goods into the United States. And it's very funny because you see people complaining that, because of all these ships at sea not being able to offload, you can't get certain cereals, sugar bombs or whatever they are at your store. But the cereals are actually made in the northern part of the United States, and they're delivered to the stores by trucks. And the astounding thing is, well, there are several things that are really crazy about this. There's a 90% turnover. Truck drivers, class 8 intercity tractor trailer truck drivers, there's a 90% turnover rate. A really nasty job. Quit after a year, they might take a rest and then they might come back, but there are shortages of truck drivers. It's also a longer term issue because, starting in the 1950s, the trucking industry and the construction industry convinced the Congress and the administration to build a bunch of highways and to stop subsidizing railroads. Railroads are much cheaper and much more efficient and much more energy efficient way of shipping materials from city to city. And they've been just devastated over the last 60 years in the United States, partly because the US government has chosen to subsidize trucking and interstate highways at the expense of railroads. So from a climate change perspective, in a real world, we'd say, well, we have a trucking problem. Let's finance freight railways and work on getting that freight railway system back up. But that's probably not going to happen. You know, that's a political issue, not an economic issue. But those are two of the factors that have caused the supply chain backups. This is the semiconductor business. Semiconductor shipments also have risen very sharply. You can see they actually fell in 2019, and they stayed low for much of 2020, but then they started rising and they're at record levels and they have risen very sharply. Now, these are billions of US dollars, and one of the things that's happened is that the price of semiconductors has risen too. But there are a variety of factors that are going on here. And one of them, number 4 here, is the increased concentration of ownership in the chip manufacturing industry. There are fewer competitors that can say, hey, I can make those chips, because they've been bought up by larger chip manufacturers and they've been merged into other farmer competitors. And so the competition and the availability of people to compete on price and supply is down. But there are a bunch of other issues. One of them is the very simple thing that chip shipments have risen sharply. This is in dollar terms. This is the way the industry reports it. But if you look at it on a volume basis, they're also up double digits, well over 20%, I believe, year over year changes in semiconductors, and 2019 to 2021 changes. You also have increasingly specialized chips. So it's not like you have these generic chips that you can say, oh, my chip supplier can't get those chips to me on time, so I can go to one of his competitors. There are fewer competitors, and these chips are more specialized. I need that type of chip. I can't use somebody else's chip, and somebody else doesn't necessarily make those things. So that's been one of the things. Another factor is the increased cost of building chip factories globally, which has reduced the construction and availability of chip manufacturing capacity. And as I said, you know, the increasing. I picked up bad parts of the internet, several people who were saying, well, clearly the problem with the chips shortages that's affecting auto production and everything else is that there's not enough silver for the chips. And that's clearly not true. And it's like voting fraud. You just throw these thoughts out and people will accept them. Not true. The last thing that's, it's just the availability of silver and ethically and green mined silver is ample to meet chip industry demand. That's just not been an issue. And that brings me back to this thing. I mentioned this last week. This was a comment on our video, I guess a week ago Tuesday, where somebody said, hey, you know, can you talk about physical supply and don't include paper? Because other people only talk about paper and they don't include, only talk about physical and they don't include paper. And I talked about it last week, but I wanted to talk about it a little bit more because I thought, wait a second. First off, I only know of 2 companies that actually produce data and statistics on silver, gold, supply and demand. And CPM Group is one. And we focus on physical. The others actually include some paper forwards by producers, producer hedging using forwards and options. They include that in their physical metal. They say, well, other experts who don't include paper. And I can't think of anybody else who actually gives data. So I did some research, and what I noticed was a lot of people who talk about silver supply and demand. Now, there's silver shortage. There's no silver there. Oh, insofar as London and New York and Shanghai report record amounts of silver, they're lying. Okay, if the statistics don't support my belief, the statistics must be lies. Yeah, okay, that works. Yeah, yeah, Trump won Georgia, sure. So I'm not sure who these experts are who only look at physical, because I just don't see those numbers. And in looking at that, I came across several things. Oh, the supply chain disruptions are because there's not enough silver. Oh, the semiconductor chip shortage is because there's not enough silver. Oh, the US Mint has been making silver coins all year long because they can't get silver. All of which is just not true. And there's no physical silver data behind it to support it. But there is physical silver data to refute those things. They just don't talk about the data, but we do. Now, some of these things are in our precious metals advisory. The November issue comes out Thursday. Some of these charts are from there. Most of these charts are from there. And some of the other information I gave you is from our trade recommendations. Gold trade recommendations are available from GoldX app and Kitco, as well as from CPM Group. The silver trade recommendations that we produce are available to our paying clients, people who have a retail investor program agreement with us, get the gold and silver trade recommendations directly. Forum scheduled for next Wednesday. I noticed that somebody who likes to try to compete with us has booked a silver online webinar for the same period of time, but we're just going to live with that. Excuse me about that. You can see an introduction to CPM Group and information about our yearbooks on our website. We produce a variety of research, mostly on physical commodities, but we also talk about derivatives, futures, forwards, options, indexed notes, indexed bonds, things that affect the price and supply and demand of the physical market. That's all I have for now. I'll talk to you on Friday. Take care and have a good week.